Right now, while the markets are still pretending everything is normal, the next 2008 collapse is already underway. Not coming, not approaching, underway. And this time, there is no rescue lever left to pull. In 2008, the system survived because there were still tools available. Rates could be cut, balance sheets could be expanded, trust could be temporarily restored. Today, every one of those tools has already been used, exhausted, abused, pushed past the point of return. Most people remember 2008 as a housing crash. That's the lie that made it easy to digest. Housing didn't break the system. Housing exposed it. The real failure was leverage layered on leverage, wrapped in complexity, disguised as safety. Mortgages were just the ignition. The fuel was a financial system built on promises that could never all be honored at once. And here's the part nobody wants to admit. The system was never fixed after 2008. It was stabilized, patched, kept alive through artificial means. What was supposed to be a temporary emergency response became permanent life support. Quantitative easing didn't end. Zero rates didn't normalize. Debt didn't unwind. It multiplied. Since 2008, global debt has more than doubled. Government debt, corporate debt, household debt, all of it growing faster than real economic output. That alone tells you something is wrong. When debt grows faster than the system meant to service it, collapse isn't a possibility. It's a timing issue. Back then, central banks had credibility. When they said they would do whatever it takes, markets believed them. Inflation was dormant. Bond markets trusted the math. Today, that trust is gone. Inflation has already proven that money creation has consequences. Bond markets are revolting. Yields are rising not because growth is strong, but because confidence is breaking. This is what makes the current situation fundamentally different. In 2008, deflation was the threat. Today, inflation is the trap. You can't print your way out of a confidence crisis without destroying the currency itself. Every dollar injected now weakens the foundation further. Every bailout accelerates the endgame. And while everyone is watching stocks, something much bigger is happening beneath the surface. Liquidity is vanishing from places that are supposed to be deep and stable. Treasury markets are showing stress. Repo markets are flashing warnings. Banks are quietly tightening lending standards even as officials claim everything is fine. That contradiction is never accidental. The system is telling you something through its behavior, not its headlines. When banks stop trusting each other, when collateral quality suddenly matters again, when cash becomes more valuable than promises, the cycle has already turned. That's where we are now. This isn't a repeat of 2008. It's the consequence of 2008. The bill that was deferred for over a decade is finally coming due. And, unlike last time, there's no larger balance sheet waiting to absorb the shock. By the end of this video, you'll understand why the collapse already in motion cannot be reversed, why the familiar rescue narratives will fail, and why this crisis ends very differently than the last one. Not with relief, but with a reset the system itself cannot control. To understand why this collapse can't be stopped, you have to look at what actually breaks first in modern financial crises. It isn't stocks, it isn't housing, it isn't even banks. It's trust in the collateral that holds the entire system together. In 2008, the problem was toxic assets. Mortgage bonds that were supposed to be safe suddenly weren't. But once central banks stepped in, they replaced bad collateral with good collateral. Treasuries, cash, guarantees backed by sovereign balance sheets that markets still trusted. That swap restored confidence long enough to reset the clock. Today, the collateral itself is the problem. Government debt is no longer viewed as risk-free. That's the line nobody wants to cross publicly, but markets already have. When bond yields rise while central banks are trying to stabilize conditions, it means buyers are demanding compensation for risk they never used to price in. That is a silent vote of no confidence. Think about what that implies. Banks hold massive amounts of government bonds as safe assets. Pension funds rely on them to meet future obligations. Insurance companies depend on them to match long-term liabilities. If those assets lose value at the same time liquidity tightens, the entire structure starts to strain. Not violently at first, quietly, subtly, then all at once. This is why you're seeing stress appear in places most people never look. Overnight funding markets, repo rates, bank term funding programs that quietly get extended again and again. These are not signs of strength. They are signs that the plumbing is clogged. When the pipes stop flowing freely, pressure builds everywhere else. In 2008, central banks could flood the system with cheap money without consequences because inflation wasn't a threat. Today, inflation is the constraint. Every attempt to stabilize markets risks reigniting price pressures that erode purchasing power even further. This creates a trap with no clean exit. If policymakers tighten too much, something breaks. If they loosen too much, the currency weakens and inflation accelerates. Either path destroys confidence. That's the core difference between then and now. The system is cornered. This is why you're seeing officials speak carefully, choosing words like higher for longer and data dependent. They're buying time. But time doesn't solve a structural imbalance. It only increases the scale of the adjustment when it finally arrives. And while most people assume the next crisis will look dramatic from the start, that's not how these unfold. They begin as slow freezes. Credit stops flowing to small businesses. Loan approvals quietly decline. Asset prices stay elevated, but transaction volume collapses. The market looks calm on the surface while stress builds underneath. This is exactly the phase we are in now. The warning stage. The part history shows is always ignored because it doesn't feel like an emergency yet. But by the time it does, the outcome is already locked in. Every systemic collapse follows a sequence so consistent it almost feels scripted. Not because history repeats perfectly, but because human behavior does. The incentives never change, so the outcomes don't either. First comes excess leverage. Cheap money encourages risk-taking. Debt builds faster than real productivity. Asset prices rise not because value increases, but because liquidity does. This phase feels good. It creates wealth on paper and convinces everyone the system is healthier than it really is. Then comes mispricing. Risk is underestimated because nothing has gone wrong yet. Models assume stability because stability has existed recently. This is when financial engineering replaces common sense, complexity increases, transparency decreases, and accountability quietly disappears. Next comes the trigger. It's never the real cause. In 2008, it was subprime mortgages. In earlier crises, it was currency pegs, commodity shortages, or sovereign defaults. The trigger is simply the spark that exposes fragility that already existed. After that comes denial. Authorities insist the problem is contained. Analysts argue it's localized. Media focuses on surface-level explanations while ignoring structural weaknesses. This phase can last months, sometimes years, because confidence is a powerful anesthetic. Then comes acceleration. Liquidity vanishes, correlations spike. Assets that were supposedly unconnected start moving together. Safe havens fail, emergency measures appear overnight. And suddenly, the narrative flips from everything is fine to no one saw this coming. What makes this cycle dangerous today is that we are seeing multiple stages overlap. Excess leverage never fully unwound after 2008. Mispricing became permanent policy, and denial is now institutionalized. The system survived the last crisis by pulling future stability forward. Zero interest rates, quantitative easing, balance sheet expansion. On a scale never seen before. Those tools worked once because they borrowed credibility from the future. But that future has arrived and the bill is due. This time, the accelerant isn't housing or tech stocks. It's sovereign debt itself. When governments become the most leveraged entities in the system, there is no higher authority left to absorb losses. Central banks can create liquidity, but they can't create trust once it's gone. That's why this cycle doesn't end with a bailout that restores normality. It ends with a reset that changes the rules. New regulations, new currencies, new settlement systems, sometimes new geopolitical alignments. The reset isn't optional. It's the mechanism that allows the system to continue under a different framework. Most people misunderstand resets because they imagine collapse as a sudden event. In reality, it's a transition. Old assumptions slowly stop working. Old guarantees quietly fail. And by the time the public recognizes what's happened, the new system is already in place. We are not waiting for the next 2008 moment. We are living in the early chapters of the reset that follows it. The signals are already here. The only question left is whether you recognize them while there's still time to respond rationally. Most people assume they're protected because they're diversified. Stocks, bonds, real estate, cash. On paper, it looks balanced. In a normal market cycle, that logic works. In a systemic reset, it fails completely. The reason is simple. Diversification only works when assets respond to different forces. In a true crisis, the force is the system itself. When trust in the system erodes, everything priced inside it starts moving together. Correlations go to one. Liquidity becomes more important than valuation, and forced selling overrides fundamentals. You've already seen early signs of this. Bonds selling off at the same time as equities. Real estate losing affordability while prices remain artificially high. Cash losing purchasing power even as people cling to it for safety. These contradictions confuse people because they don't fit old models, but they fit perfectly in a reset environment. In 2008, diversification failed briefly, then recovered because the system itself was saved. This time, the system is the liability. Central banks can stabilize markets, but they can't restore faith without sacrificing the currency. And governments can guarantee deposits, but they can't guarantee purchasing power. That's the trade-off no one wants to say out loud. Stability versus value. You can preserve nominal numbers or real wealth, but not both. Every historical reset forces this choice. This is why resets always punish savers first. Cash feels safe, but it's a promise backed by policy. When policy changes, the promise changes. Inflation is not an accident in these periods. It's a release valve. It reduces debt burdens by quietly transferring value from holders of currency to holders of real assets. And this is where people get trapped psychologically. They wait for confirmation. They want certainty before acting. But resets don't announce themselves clearly. By the time confirmation arrives, prices have already adjusted. The window closes silently. The uncomfortable truth is that safety during a reset doesn't come from complexity. It comes from simplicity, assets that don't depend on someone else's balance sheet, assets that exist outside the credit system, assets that can't be diluted or restructured by policy decisions. This doesn't mean abandoning everything familiar. It means understanding what you actually own. A stock is a claim. A bond is a promise. Cash is an IOU. In normal times, those distinctions don't matter much. In a reset, they matter more than anything else. The next phase of this transition won't look like panic at first. It will look like adjustment, new rules framed as temporary measures, new programs introduced as safeguards, new language designed to reassure. But every layer added reduces flexibility and increases fragility. By the time the public realizes diversification didn't protect them, the reset will already be well underway, and the choices available then will be far more limited than they are now. Resets don't happen because policymakers want them to. They happen because delay becomes more dangerous than action. And right now, multiple pressures are converging in a way that removes the option to wait. The first pressure is scale. The system today is simply too large to stabilize with the tools that worked before. Debt levels are not just high, they are mathematically incompatible with sustained high interest rates. Governments can't refinance cheaply anymore, yet they can't cut spending without triggering social and political backlash. This creates permanent stress at the core of the system. As the second pressure is demographics. Aging populations mean fewer workers supporting more dependents. Pension systems that assumed decades of stable growth are now facing reality. Promises made under one economic structure are being paid under a completely different one. That gap can't be closed without either default or debasement. Historically, debasement wins. The third pressure is geopolitics. The era of frictionless globalization is over. Supply chains are being duplicated, reshored, and weaponized. This increases costs across the board. Inflation is no longer a temporary event caused by shocks. It's structural. And structural inflation destroys the old playbook of endless stimulus. Then there's the feedback loop. Rising rates weaken balance sheets. Weakened balance sheets force intervention. Intervention weakens currencies. Weaker currencies raise import costs and inflation. Higher inflation forces higher rates. Each loop tightens the trap. This is why the language coming from institutions has changed. You hear phrases like managed transition and new framework. These aren't technical terms, they're signals. They mean the old assumptions no longer hold, and the system is being reconfigured in real time. What makes this moment different from every prior crisis is that there is no external anchor left. In the past, gold anchored currencies, then productivity anchored growth, then credibility anchored policy. Today, even credibility is strained. When trust becomes the scarce resource, resets accelerate quickly. This is the point in history where outcomes stop being determined by forecasts and start being determined by positioning. Those who recognize the shift early adapt. Those who cling to old models experience the reset as a loss rather than a transition. The system doesn't collapse overnight. It transforms. And transformation always rewards those who move before the rules are finalized. The end of a cycle rarely looks like an ending. It looks like normalization. New rules rolled out quietly, new structures presented as upgrades, new systems introduced under the language of stability and protection. Most people don't resist because nothing appears broken on the surface. Life goes on, markets open, transactions clear, but underneath, the rules have changed. This is how resets succeed, not through chaos, but through acceptance. People adapt to the new framework because the alternative feels worse. Restrictions feel reasonable, controls feel temporary, and over time, what once would have been unthinkable becomes standard. In 2008, the reset restored faith by centralizing risk. Today's reset does the opposite. It redistributes risk outward while centralizing control. That's why the system can't be saved in its current form. Saving it would require reversing decades of structural decisions. No government will do that voluntarily. Instead, the reset moves forward, gradually at first, then faster. Asset values recalibrate, purchasing power continues to erode, and wealth concentrates around those who already hold claims on real productive assets. This isn't a conspiracy, it's arithmetic. The public won't be told a reset is happening. They'll be told it already happened and that the new system is working. By the time that message lands, the opportunity to reposition will have noted. That's the defining feature of this moment. Not fear, not panic, but asymmetry. Information reaches some people earlier than others, and that gap determines outcomes. If you understand where we are in the cycle, you stop reacting to headlines. You stop waiting for confirmation. You stop expecting a rescue that restores the past. You start thinking in terms of durability instead of growth, resilience instead of yield. The next 2008 isn't coming. It's already underway. And this time, there's no reset button that returns us to what was before. There is only transition. The system will continue, but it won't save everyone equally. The only real question left is whether you recognize the shift while there or S still room to move, or whether you were forced to adapt after the rules are finalized.